system millions trusted collapsed in hours, quietly transferring power to institutions that promised stability afterward. October 1987 wasn't chaos alone. It was an opening Wall Street never relinquished afterward. Markets didn't just crash that day, they rewrote who controlled risk, rescue, and future rules. The mystery isn't why prices fell, but who gained permanent authority when fear peaked. Before 1987, markets still believed discipline mattered and failure carried consequences. Regulation existed, leverage had limits, and central banks hesitated to intervene aggressively. But technology changed everything faster than safeguards could adapt. Program trading promised efficiency, speed, and risk reduction through automated selling strategies. Instead, algorithms amplified panic, turning human fear into machine-driven avalanches. This single detail changes everything about accountability during modern financial crises. When selling triggered more selling, liquidity vanished instantly across global exchanges. Traders watched screens collapse faster than human judgment could respond. The Dow fell over 20% in one day, shattering historical assumptions. Confidence evaporated not because fundamentals vanished, but because trust in mechanisms collapsed. But this is where the story turns dark. Instead of questioning automation, authorities chose to protect markets at all costs. The Federal Reserve stepped in as lender of last resort, immediately signaling future rescues. This action stabilized prices but rewired incentives permanently. Risk was no longer fully owned by those taking it. Losses became socialized, while gains remained private. Wall Street learned a powerful lesson that day. Markets would not be allowed to fail freely. This implicit guarantee became known later as the Fed put. Traders could now gamble knowing central banks feared collapse more than excess. Leverage increased steadily, justified by confidence in emergency intervention. Complex derivatives flourished, promising safety while hiding systemic fragility beneath layers of math. Banks grew larger, interconnected, and politically indispensable. But this part was quietly erased from public memory. The crash wasn't treated as a warning, but as justification for permanent support structures. Circuit breakers were installed, pausing panic without addressing root causes. Stability became performance, not resilience. Over time, intervention replaced discipline as the core market principle. Each rescue confirmed expectations, reinforcing moral hazard across financial institutions. Risk managers adjusted models assuming future bailouts were inevitable. Capital flowed toward speculation rather than productive investment. Main Street saw fewer benefits while asset prices inflated rapidly. Wealth concentrated upward as financial engineering outpaced wage growth. But this is where the story turns darker still. Regulators began revolving through Wall Street firms they supposedly oversaw. Policy decisions increasingly reflected market sensitivities, not public interest. Finance became too important to challenge directly. The 1987 crash normalized emergency thinking during every downturn thereafter. Crises justified extraordinary measures that quietly became permanent policy tools. Interest rates trended downward, distorting price discovery across assets. Debt replaced savings as the primary growth engine. Each cycle demanded larger interventions to sustain confidence. By the 2000s, this framework was unquestioned orthodoxy. Then came 2008, confirming everything Wall Street learned in 1987. Failures were rescued, executives survived, and institutions emerged even larger. The precedent set decades earlier proved decisive. The takeover was complete, not by conspiracy, but by conditioned response. Markets stopped disciplining behavior. Central banks did it instead. This single shift altered capitalism's feedback loop fundamentally. Risk no longer taught lessons. It triggered rescues. Innovation increasingly meant financial complexity, not productivity or shared prosperity. Public debt ballooned as private risk migrated onto balance sheets. Trust eroded slowly as people sensed unfairness without seeing mechanisms clearly. But this part was quietly erased from mainstream explanations. The 1987 crash wasn't just a failure, it was a blueprint. A blueprint for permanent intervention disguised as stability. A blueprint Wall Street refined relentlessly afterward. Today's markets still operate under assumptions born that October. Algorithms dominate, leverage persists, and confidence rests on central bank credibility. When volatility spikes, eyes turn immediately to policymakers. Intervention is expected, priced in, and demanded. But confidence built on guarantees is fragile by nature. When guarantees stretch credibility, panic returns stronger than before. History shows systems collapse when backstops lose believability. The warning isn't theoretical. It's structural and repeating. Every rescue increases future dependence. Every delay magnifies eventual consequences. Three truths emerge clearly from the 1987 transformation. First, crises redistribute power toward those closest to emergency levers. Second, moral hazard grows invisibly until discipline disappears entirely. Third, permanent intervention replaces markets with managed outcomes. The warning remains unresolved and increasingly urgent. What happens when intervention fails to restore confidence next time? What happens when debt limits responses policymakers once relied upon? The question isn't whether volatility returns, but who controls the response. Understanding 1987 explains why Wall Street never truly relinquished power afterward, and why the next crisis may test faith in the entire system.